Okay, so we've got around 80 odd people joining. So welcome again. So my name is Lee Newman. I'm the franchise director looking after the Southeast. And of course, my business consultants are out there talking to you on a day-to-day basis. I'd like to introduce Julie. Julie is our advisor development, head of advisor development. So Julie looks after the development of skills both across our advisor base, but also with us as a distribution channel. Julie's a great person to advise us on how actually to get the best out of protection opportunities. And it's great to have you along, Julie. Thank you. And
Thanks.
of course, I was going to say an old face, but it's a young, fresh face, and that is Gary King. So Gary King is our head of protection. From a technical perspective, so all the difficult questions that I come across usually end up on Gary's desk for me to relay back. So thank you again, Gary, for joining us. So here we are talking about income protection, an amazingly important part of the market. Vitality, it is such an important area for Vitality. We have this webinar coming off the back of IPAW, which has been an important industry event trying to raise the awareness of the need for income protection. And it's certainly a product area that Vitality are both very strong in, but also have large ambitions for. Today's session is going to last about 30 to 40 minutes. We're going to have a Q&A session at the end. So that's enough from me. I'm going to pass over to Julie, I think, aren't I? Yes, Julie.
Yep.
So over to you, Julie.
Thanks, everyone. It's really good to be here talking about IP this morning. I think it would probably be good to start off by having a look at where we are as an industry. And I think, we know that there's a big focus on income protection. Like Lee said, we've just come off the back of IPAW. But I think since COVID, there's probably been the biggest growth that this sector, income protection, has ever seen. And if we reflect as to why that is, I mean, I think there's a couple of reasons. First of all, I think that for the first time, perhaps, everybody realized that Kick had some gaps. No matter how enhanced the Kick product was, there were things that weren't paid for. So when you had a client coming to you saying, I'm really, really ill, I have COVID, do I have a payout on my critical illness plan? The answer would have been, no, you don't. And so immediately the need for income protection was highlighted. I think also because of this concept of furlough, I think people really valued what happened when they were unable to go to work, that their income still came in, and they stopped and wondered and asked themselves a question, like, what would happen if I was unable to go to work and the furlough scheme wasn't kicking in? Like, where would my family be over COVID if we didn't have that income coming in? So I think that basically those kind of two things combined, together with the focus in the industry on income protection, has led to this growth that we've seen over the last couple of years. But I think if we have a look at Vitality's market share, we have too, as you would imagine, have grown over this period, but we've grown exponentially. So if you just look over the last year, our IP sales are up by 68%, which is 5 times as fast as the rest of the market. And a lot of people are curious about that. Like, we know that obviously when they say when the tide rises, all boats will rise. But why is it that we are increasing higher or faster than the rest of the market? And today we hope to answer some of those questions as to what it is about our product that has led us to have this exponential growth. The other thing that we are going to also be kind of touching on is, as you know, or as you may know, Protection Guru Pro score Vitality's income protection top when it comes to quality. And again, that's the question, is like, what is it about our product that allows a service like PGP to actually score us in so highly from a quality perspective? And I think what we think, like, why is it that we've had this exponential growth, and why is it that we score top with PGP? I think it has got a lot to do with the fact that we're out there and we're listening to the challenges that advisors face when it comes to income protection. And there are challenges in the market when it comes to giving advice on income protection, challenges that are different to life insurance and certainly different to serious or critical illness. And some of those challenges, I think we're going to be having a look at today. So the first one is the fact that when it comes to claim, your claim is a payout based on your pre-incapacity earnings. It's not a payout based on the benefit that you have. And that is a challenge from an advice perspective. And the second thing I think that's a big challenge that advisors face is the fact that life happens, right? So you meet a client today and you will give them advice based on their current circumstances. But everything changes, like from that next month, potentially things can change. People can change jobs. They increase their mortgage term, their salaries go up and down, all of those things happen. And in order to give a client a product that will actually match those changes in life, or as best as possible, align with those changes in life, can be challenging. And so I think that's probably what we've done really well as a provider, is that we've had a look at those two challenges and we've designed our product and really baked that in to what our product looks like, those challenges. So I'm now going to hand over to Gary, and he's going to talk you through what we're going to talk about today, and have a look at potentially one of the first challenges and how we overcome those. Thanks, Gary.
Thanks, Julie. Good morning, everyone. So I think before we start, I think it's really interesting to look at the spread of people we've got on the call today. And obviously, those of you that are regularly talking about income protection, I'm sure probably a couple of these challenges are things that you've come across before, and obviously have your own ways of dealing with them. Hopefully, of course, you've come across the Vitality approach, and some of these things won't be particularly new, but we want to take a bit more of a deep dive into some of those solutions. And for those of you that have not written income protection before, these might be things, of course, that you've not really come across, you've not considered. So hopefully this gives you a good sort of jumping off point, if you like, for when we get into writing income protection, just being aware of some of the, I suppose, I'm not going to say potential pitfalls, that's probably not the right way of putting it, but some of the challenges you may face when we get into sort of regularly recommending income protection. So we're going to start with the verified earnings guarantee. I think this is, I think for me, our most important unique point. It is completely, say, unique to Vitality in our approach. And I think when we get into the bones of how this can impact not just your advice, but also the ultimate benefit that your clients will receive, and the benefit ultimately that they expect to receive, how this really adds a lot of, I suppose, a lot of value to your recommendation from a client point of view, but a lot of, I suppose, protection from an advice standing that ultimately means the client will get what they're expecting to get. So let's take a look at that in a bit more detail. So I think this is always a great question to start with. How important is certainty, not just to your client, but I also think to your advice as well? Because I suppose when we look at all of the products that we regularly talk about, whether that's life cover, serious illness cover, critical illness cover, it is always a fixed payout. You know what you're going to get. Obviously, within the confines of it being increasing or decreasing, it's going to follow that fairly regimented path. There will never be any financial underwriting at point of claim. That's always done at point of application. But when we move into income protection, there is a difference there. Of course, we can't be overinsured. We know that obviously whatever provider you're looking at, you're typically going to be restricted to 60% of your income as your benefit level to make sure that the individual's not overinsured. But of course, as Julie quite rightly mentioned earlier on, life happens. Income increases, decreases, people change occupations, and we need to be able to, I suppose, prevent that having an impact on what the client is actually going to get. And that's exactly what the verified earnings guarantee is designed to tackle. So to put that into context through a case study, let's look at Carla here, working 40 hours a week, earning £5,000 a month, so 60% benefit there, affording Carla £3,000 a month of benefits. Now, sadly, of course, as we know with income protection, the majority of claims that we tend to look at will be things that will be debilitating to a certain extent. And these are things that, of course, can have a build-up or a lead into actually needing to take time off work and needing to sort of start the process for making that claim. So musculoskeletal, of course, being one of the key claims areas for income protection. If, in the instance here, Carla has had a back injury, maybe that's something that's been getting worse over time. She's been trying to continue to go to work and obviously sort of muscle through it, so to speak. that's led to a drop in income in the build up to Carla finally sort of throwing the towel in and saying, oh, I do need to take some time off to recover here. And this is where that point about being underwritten at point of claim is going to really impact her. So, of course, her income dropping to £2,000 at point of claim. With everybody else in the market, that is going to be considered in their re-incapacity earnings. So, and I think if we just consider, I suppose, outside of the wider, I suppose, into the wider impact on your client bank, this is anybody who is based on dividend income or bonus or overtime or commissions to a certain extent, all of these things that could potentially reduce in the lead up to a claim. We, of course, are looking at in this scenario where Carla's income has dropped to £2,000. That's going to be financially assessed at point of claim. And then obviously the provider is only then going to be able to pay 60% of that income. Obviously, some providers will have slightly different amounts here, 65, for instance, depending on how the provider you're working with will consider this. Again, for us, we are at 60%. So we would be looking at that £1,200 worth of benefit. And I think ultimately this leads to quite a difficult conversation. That client is going to reach out to you, of course, to instigate that claim. Great news, claim's been admitted, and then, of course, payments start being received, but client's only receiving £1,200. I'm sure they'll be on the phone to you relatively quickly to ask, has there been an error here? I've been paying for £3,000 a month and I've only just received £1,200 into my bank account. You'd like to think that we might get over that objection a little earlier, but ultimately that is the way that, of course, these policies will work. However, moving to the other side of that, of course, Vitality giving you the ability to lock in that benefit at point of application, so we can complete financial underwriting during the application process or within the first 6 months of starting that plan, and we then have the ability to lock in that benefit level. So as long as the client is still working at least 16 hours a week, when we get to that point of claim, we've gone through that process of locking in that benefit, that client will get the full £3,000, basically getting what she's been paying for. So no nasty surprises, and ultimately this is again tackling that point around the fact that life will change. Your income may drop, you might choose to change occupation throughout the term of your recommendation. So this just gives you that safety net to make sure that ultimately the recommendation you make will stand the test of time, will adapt to those changes that the client's situation has led to, and again gives you that confidence in your recommendation. And I just think when we look at our claims report from last year, this really starts to highlight the value of this approach, because I suppose the obvious one in here that we look at, if you go to sort of stroke and nervous system, you would have been working probably flat out up until the point you've had that stroke, and then there's that immediate absence and that need to claim. Whereas everything else we look at here, musculoskeletal, of course, mental health, two of the key ones there. Certainly, cancer patients, there's some interesting research done to show how many people will work throughout those early stages of treatment. Of course, that might then lead on to a worsening of that condition, and certainly not allowing those clients to focus on the thing they need to focus on, of course, which is getting better. So we do tend to see that the majority of claims for income protection are in those areas where we might try and sort of muscle through for the early stage, and that never really helps on people's recovery, does it? So it really does highlight how important this is. So I think there are a few key reasons to start with why you should consider verifying income for all clients. And of course, I suppose the first thing that we'll think about here is any client we've got that has changeable income. So whether that's dividends or bonuses or commissions and the like, I think it's really important that we are able to lock in that benefit and get what the client pays for. But there are also a few other key reasons why this might be of benefit to more of your clients. So certainly from your point of view and from the client's point of view, they have that peace of mind knowing that that benefit is locked in. It gives them that flexibility to make changes throughout the term of the policy. Often we're talking 25 or 30-year recommendations here. We need that confidence that the recommendation we're making will stand the test of those challenges. But also it allows us to have the client choose if they wanted to work less hours a week. 2 days a week, if you were making some significant changes or had other issues in your life, knowing that you still have that policy running, which will continue to do as you expect it to do, even considering a fairly significant reduction in working hours, I think gives real benefit there as well. And the last point, and of course, I think a particularly important one, is the ability to make sure we're getting those claims done faster. We're not going to need to provide financial evidence that the client was earning what they suggested they were earning at point of application, and are just allowing us to really speed that process up. We have to request less information. I think a key driver for this, of course, is a client is going through something that's, not particularly pleasant. We want to make this sort of claims process as streamlined and straightforward as possible. And obviously, ultimately, again, getting money to the client as early as we can is always going to lead to a better outcome. So I'm going to pass back to Julie to take on the next stage about introducing indexation into our conversations around income protection. Julie.
Thank you, Gary. You want to put on the next slide?
Excuse me.
Perfect. All right. So I thought we'd start off with a little quiz, Gary. Let's see how good you are this morning.
Okay.
And it's just simple. It's just true or false. So if your need is decreasing, you need decreasing cover, like, for example, a mortgage. Is that true or is that false?
I'm going to go with that being true.
That's correct. It's true. And if your need is decreasing, do you think that you would need decreasing? If your need is increasing, do you think you would need increasing cover? For example, it was linked to expenses that you were covering.
Again, I'm going to go with that being true.
Absolutely. So if your need is increasing, you would need increasing cover. So if we have a look at an example, and we have a look at an example of someone who's taken our 25,000 cover per annum as income protection, 20 years later, that is going to effectively be worth 12,000. So if we think about that, without adding indexation, we haven't really given somebody a level income protection plan. We've, in fact, given them a decreasing income protection plan. And I think that when we see it from that perspective, it's and also letting a client understand that, because I think from an advisor perspective, we all appreciate the importance of indexation. I don't think anybody on the call needs to be convinced about the benefit and the importance of indexation, but sometimes a client needs to also be reinforcing. So saying to a client something like, I'm going to be giving you an income protection plan that's going to keep up with your needs, rather than decreasing income protection plan. Sometimes that's just a way to position that. I also think that certainly from the advisors that I've spoken to when I do my workshops, I ask the question, like, what is it about indexation that potentially you worry about? And obviously this idea that ultimately over time the premium will become too expensive and the client will want to cancel is a concern that many advisors have. And I think that really from a sales process perspective, it goes back to letting clients understand the value of what they're actually being given. So taking a little bit of time to educate the client about what indexation, or we like to call it cost of living protection, what that actually means to you. I'm adding this benefit because what it does is it allows you to increase your cover every single year free of medical underwriting. And what that means is that we know, as being part of the industry, how particular underwriters can be when it comes to certain health conditions. So if you develop a condition that the underwriters deem to be too risky, they may not want to give you any more cover. And as we spoke before, we do not want you to have an effectively decreasing income protection plan. So this is a really valuable benefit that I'm adding, allowing you to increase your cover every year without underwriting. But the good news is that you don't have to accept that benefit and effectively correlating premium increase every single year. If you get to a year where you think, you know what, I just actually can't afford this increase, you can say, no, thank you. I don't want to take that benefit increase 3 times in a row before Vitality will say, okay, fine, we'll stop offering that to you. Some providers will be only 1 time. It all depends on how the product is structured. But ultimately with Vitality, clients have got the option to say no, thank you. I'm not wanting to take it up this time without losing that benefit. And that really what it does is it puts the client in control. It gives them the choice. And we really just have to think about and even positioning to your client to say, I don't want you to ever come to me and say, I need to increase my cover because my circumstances have changed. But I unfortunately have had a medical condition, or it might not be a serious medical condition that will result in a claim, but it certainly could result in an exclusion or a loading or even a decline in terms of that increase. So I think that positioning it right up front with the client in that way can really help to make the client see the value of the benefit that you are adding. I think what we also hear a lot in the industry is this idea that advisors need to be careful of adding indexation because a client can become overinsured. And the way that works for those of you who are new to income protection is that if your benefit, let's say, for example, your employer gives you a 1% RPI or 1% salary increase at the end of the year, your salary goes up by 1%, but your benefit, which is what you've insured with the insurer, that goes up by RPI, which let's, for example, say is 3%. So clearly, over time, if that keeps on happening, you will have a situation where your salary is quite substantially lower or could be substantially lower than what your benefit is. And as Gary said earlier, the problem at claim stage with traditional insurers is that they will calculate the benefit based on your pre-incapacity earnings, which is going to be lower than your benefit amount. And that in itself is a problem. And so the way that you can overcome that is either make sure that you see your client every single year and go through the process of checking to see that their benefit is aligned, or ultimately you can verify the income with Vitality upfront, because we lock in those indexed increases as well. So even when you're putting on, even if after a period of time, the benefit is increased by higher than what the salary has increased by, those are locked in too. So your client can't be overinsured and they'll always get what they pay for. So remember, Gary said there were 4 reasons why we should verify our income. Well, I'm now just adding a 5th one, and that is that, in fact, by verifying your income, not only do you lock in your benefit, but you also lock in your increases too. I think also from an annual or an anniversary letter perspective, I think we do a really, really good job here. Certainly from a provider perspective, I think we stand out in terms of the information that we give our clients at policy anniversary in terms of the benefits that they've received from Vitality. But I just love the way that we positively frame the premium increase. We don't just say, oh, by the way, your premium's going up because your benefit's going up. We frame it to say, like, you've boosted your payout in a positive way. So the client is really clear about why it is that they are paying an extra premium because their benefit has been boosted. Good stuff. Back to you, Gary.
Thank you, Julie. Cheers. So now we want to kind of really tackle that second objection or challenge we see here around product flexibility. And again, coming back to that point about life changing, life happens. These are long-term recommendations. You know, I suppose when we're talking about those lump sum benefits, as we mentioned earlier on about knowing the payout you're going to receive because we've completed financial underwriting at point of application, I think there's also an impact there of typically we know what that journey is going to look like if we're doing a lump sum benefit for mortgage protection, for instance. Within a certain degree of certainty, we can see that the mortgage is going to continue to be paid down, and that should meet the requirements of the protection we've recommended. But when we're talking about income protection and people's journey through certainly being employed through the long term, we don't see many people that stay within the same job for life. People can obviously pivot, change paths from a career point of view, go from employed to self-employed, decide to go it alone and set up their own business, or take a period of just, you know, starting a family, focusing on that, for instance. So we need to make sure that the product provides flexibility to meet those needs. So, you know, we looked at Carla earlier on. Let's just take a look at some of the other things that might happen to Carla over, let's just say, the next sort of 20, 25 years when it comes to, you know, the career path that she's taken. So we touched on it a second ago, but that, you know, potential for changing job, going from a employer that will offer a longer period of sick pay, for instance. Certainly we see a lot of this within the public sector space, people deciding to exit the public sector and go private. Again, another key change here, that you've gone from a position where you could have up to 6 months full, 6 months half, to having very little sick pay. So the ability to change the deferred period in line with the new job is an important change we need to be able to make. Certainly, I've just done this one myself, extended my mortgage term to make sure that I can bring my payments down in line with fairly, I mean, the interest rates are looking a bit better at the moment, but certainly we've seen an increase. So the ability to change term, again, under guaranteed insurability to build in that flexibility, I think really, really key change. As Judy just looked at, the idea that, of course, our income is going to potentially increase, but not quite as quickly as RPI, having that flexibility, not just to elect whether you do or don't want to take that RPI increase this year, but also the certainty through that verified earnings guarantee that if we are going to accept that increase every year, we don't have to worry about our level of cover outrunning or outpacing our increase in income. Again, talking about some of the things that we might see from a claims perspective, of course, if we have things like back injuries or instances of poor mental health, certainly the ability to get support ongoing, I think, is really, really important here. Certainly, if we've had anything that's stopped us from working for a spell, we really want to make sure that we're doing everything we can to prevent that happening again, and certainly speed up the recovery when we have these sorts of instances. So offering recovery pathways alongside our income protection, basically access into our private medical proposition to support that client's journey back to work as quickly as possible, rather than having to rely on the NHS. Certainly, again, I don't want to be the one joining the back of that 7.6 million person queue at the moment. So again, really adding some extra value there and making sure that we're supporting the client as much as possible. You know, for say we've looked a couple of times at obviously income or injury, sorry, having meant that Carla needed to reduce hours, potentially certainly having a child, maybe would like to take a step back from career for a little while to look after young children, or even potentially add in our serious illness cover for children. Obviously, with our children's cover being a standalone policy, you can add it to anything, a life-only policy, a life and income protection policy, rather than having it be linked specifically to the adult serious or critical illness benefit is a real use there. But again, just that overall ability to be able to reduce your hours, either because we've made a change in career, we're looking after a child, or of course because of injury, that verified earnings guarantee, locking in that level of benefit, removing the uncertainty that we have about how this policy is going to effectively pay out when it's needed to. But I think the key thing for me here is all of these benefits, all of this flexibility, all of this these options to make sure your plans can adapt and can cope with life happening. All of these are completely free of any additional medical underwriting. They are all available under either our guaranteed insurability options, that ability to change the deferred period, change the term. Of course, you've got the ability to change your benefit level under guaranteed insurability anyway, and ability to lock in your level of benefit at point of application just removes all of the concerns around these policies not doing as you hope them to do or not being able to adapt as you would expect them to be able to. So hopefully during that we've had a look at, I think for us and certainly for Lee, Julie and myself and our sort of regular interactions with advisors, these are the challenges that we tend to find are the most popular ones when it comes to income protection, and certainly for either established or new advisors into this space, these points around what happens if, not just from an earnings perspective, but also life changing. Hopefully we've gone through how the unique benefits that Vitality offers through its income protection proposition really helps tackle those challenges. And hopefully this reinforces kind of this idea when we look at that scoring from Protection Guru Pro, it not only backs up how these USPs give you added value from an advice point of view around certainty and flexibility, but also how that leads to better outcomes for the client, meaning that the client will get the benefit that they are expecting when they are getting it. And to the point of Julie raised it earlier on with indexation, when you realize you need to increase your cover, it might be the point where you're no longer able to get standard rates or cover without exclusions. And I think that works exactly the same when we come to the changes that clients might want to make to the sort of broader structure or setup of their plan. Again, not being able to get standard rates at that point is going to really impact the advice we're able to give our clients. So having that flexibility built in really helps support the scoring that we're seeing here from Protection Guru Pro. So that leads us nicely on to some questions. I keep seeing some things pop up in the chat, Lee. So hopefully you've answered them all. And
Some of them I have, but some of them are worthy of wider communication, I think, Gary. So I've got four that seem to be a bit of a common theme.
Mhm.
So the first is Vitality unique in offering verified earnings?
yes. So when we look at the other offerings that are available from the market, I think it's probably readily accepted now that most providers will give a £1,500 minimum benefit guarantee sort of across the board. And then we'll double that for surgeons or doctors specifically. So again, we do the same in that regard. We will give the £1,500 sort of minimum benefit guarantee. What's being strange called a minimum benefit guarantee, you still need to be earning the appropriate level of earning the right income to get you a £1,500 minimum benefit guarantee at point of application, but that is available. With ours, our earnings guarantee, we will lock in the full benefit amount up to £8,000 a month. So really being able to extend who that is available to. But it also then comes with those other points that we've raised, obviously those 5 key points about why it's worth verifying, even if we're not looking at significantly higher benefit levels because of things like speed of payment, locking in those increases. I think a really, really key one there. And just giving you the ability then to make sure that that's not going to be reduced if the client is working significantly less hours. So there's a few key ones there. I suppose I should mention, I think Exeter do a quite a good alternative here. They will allow you to lock in up to 75% of the benefit level. So not sort of obviously 100% of the benefit that we'll do. But I think key with theirs, last time I looked, it was the initial benefit level. So if you're indexing your plans, if it's going to increase over time, you're still capped at 75% of the initial benefit. So certainly, kudos to them for considering this and sort of tackling that challenge. They've just, let's say this, we've done it better.
Okay, thank you. Okay, next then, as an advisor, how would I verify a client's income? What's the process?
So for us, you have the option to do it before we issue terms. So you can select on the application that you wish to verify, and then we will ask you for the last 3 months pay slips and P60 for employed individuals, or the last 3 years SA 302s for self-employed. So I think it's worth mentioning at this point, of course, we're trying to lock in a consistent income for clients here. So there is a requirement, of course, that the client does have that longer term earnings. We don't just want to sort of lock in a good year for someone who's self-employed or a good month for somebody who's employed. Of course, that does then lead us very sort of open to anti-selection and sort of people, I suppose, abusing this fantastic benefit that we offer. So we are very much looking for a consistent income to lock in, but I would certainly suggest that for clients that do have that fluctuating income and they've got a reasonable track record of that, we'll smooth that out for them and guarantee that benefit level.
So, but it's always worth a call to our pre-sales underwriting just to understand whether or not something qualifies or not, isn't it?
Yeah, absolutely, and it's highlighted in our plan provisions. The information we'll need. So as I say, it's that 3 months pay slips and a P60 or 3 years SA 302s. You can provide that at point of application, or you can provide it within the first 6 months.
Okay, and just as a reminder, that's up to £8,000 a month for verified earnings.
Yes.
Okay, thank you very much. Okay, a question on indexation. So if a client says no to indexation, do they lose all the guaranteed index benefit levels if they say no to indexation in a particular year, or is it just for that year?
So effectively, I think the letter that Julie showed will highlight what that level of cover is currently and what it's going to go to, and then of course the premium correlating to that. They will stay, if they come back to us and say no thanks, I'm happy with the benefit level where it is, it will stay there. They will maintain that level of cover and it will maintain its guarantee as well, which is I think the great thing. Certainly when we've looked at the last few years cost of living, I think it still surprised me how many times clients chose to maintain their indexation increases throughout, when we're looking at some pretty significant pressures on families or households outgoings. People still understood the value of that cover. Certainly, it's odd, isn't it? You look at it from the point of view that all of my costs are going up because of inflation, and people are of course savvy enough to go, well, the cover I need to pay for those things also needs to increase. So yes, sadly, this is something that we do need to find the ways of keeping going as is. But it is, long story short, you maintain the level of cover you are maintaining the level of indexation and the guarantee, even if you elected to say no 3 times on the bounce, and then of course it goes to a level policy, you'll never get I suppose that option to increase again. You still maintain that guarantee, and you certainly still maintain your guaranteed insurability options for later down the line if you did want to increase the sum assured using that facility. So there are still choices in there, but yeah, you'll maintain that guarantee.
Okay, so if I've another question. So if I've recently written an income protection with Vitality, how long do I have to actually verify the earnings?
We can do it from 6 months of application.
6 months, so 6 months in. Okay. Max Cook has asked a really good question, but it's in relation to the public sector benefit that we cover. Probably we won't cover that right now, but in the follow-up email, I'll make sure that I send some information out to everybody about that. It is an amazing benefit, and we did wrestle, didn't we, when we were putting this session together, whether we'd include that in today's session. But we decided actually that would just take us over time, which we're in danger of going over anyway. Last question, I think, and thank you for. I've had some really great questions. How does Protection Guru rating change for female clients as opposed to male? So is it gender specific in terms of the scoring? Do you know?
It is. So when we look at the outputs, and I think this is probably one that I look at more when we're talking about obviously serious illness or critical illness. They will consider the likelihood of male or female having these particular instances. So when they're scoring a product, they will score it based on the inputs you put in for the client. So if we've put in a female, obviously, certainly the easiest example here, of course, things like breast cancer, obviously the scoring that they put in front of the client for things like that will become more important and get more weighting. So of course, as we've seen from an IP point of view, cancer is a very high claims area, of course, for income protection. So the fact that obviously that's going to impact females, that is going to get a higher weighting there. So we can certainly run some more examples if you'd like to take a look at one using a female example.
Okay, and then the last question, I think Peter's been particularly eagle-eyed during the session. On the example for Carla, you talked about her having minimum working hours of 16 weeks. Is that a qualification to actually benefit from the guarantee?
Should have been 16 hours.
16 hours, yes.
Sorry. Hopefully I've not made an error on the slides, excuse me.
No.
But yeah, no, it's 16 hours is once we get to the point that anyone is working below 16 hours, they will typically be viewed as a house person. And this is not just Vitality, this is across the board. There are different thresholds with certain providers. Sometimes they're 20 hours a week, 24 hours a week, even up to 30 hours a week in some instances, before you would lose that own occupation and typically be considered as a house person. And then your definition of incapacity would change probably to activities of daily living. So yes, there is that sort of key threshold in there. There is a minimum basic number of hours for you to maintain your, not just your own occupation definition of incapacity, but also your earnings guarantee as well.
Okay, and then I'm just going to throw the absolute last one in because I know I keep getting asked this question. Can you get income protection if you're on a 0 hours contract?
No, not with us.